All right, we are live, the Prospero.Ai stock market live streams. It's Stephen and Matt here, excited to kick off this stream. Happy Monday. I hope everybody had a great weekend. A lot to talk about, a lot of things happening in the market, some major events this week. But I'll let Matt share what he's going to bring up today when George joins us in a few minutes, and then I'll start heading into my topics as well. But good morning, Matt. Good to see you. What are we going to talk about today for
Good
our
morning,
viewers?
Stephen. I'm glad you're doing well, man. It's good to be back with you guys. I've been working for a couple weeks, was out traveling, but we're gonna go back 2 weeks in the newsletter because I was actually when George called me to talk about the newsletter that he wanted to talk about. I was actually on a hunting trip with my family, and George almost never calls me. He usually texts. I'm like, let's see what's going on. So I answered the phone. He's like, what are you doing? I was like, well, I'm actually, killing small defenseless animals right now. But anyway, sorry for you animal lovers. But man, he sent me some information that honestly I found fascinating. And 2 weeks ago, we called the newsletter Capped Out. And we looked at a piece of data that honestly is pretty historically rare. And here's what's going on. Two of our scores on Prospero are growth scores and our profitability scores. The growth scores look at the measure of a company's potential revenue growth over the next year or two. And so it's a company's potential to grow revenue over the next couple of years. Profitability score looks at current profitability. Well, George ran all these numbers from Prospero, and here's what we found, and we won't go into all of it right this second, but bottom line is that small caps traditionally have the highest growth scores. Makes sense, right? If you're a small cap, you have the most potential to grow your revenue over the next 2 years. Large caps that are the most profitable have the lowest growth scores. Think about Ford, right? They've got they're profitable, but they're not going to grow their revenue that much over the next 2 years. Well, what George found was fascinating is that for the first time since we started Prospero, companies that are the most profitable are having growth scores as high as small caps. And we did some research on that. That almost never happens in history. The times that it did happen in history are fascinating. And so we'll unpack that a little bit.
Wow, yeah, it's a really cool topic. I can't wait to hear all the details around that. When you're saying the large companies that are growing, I'm thinking Nvidia. I guess the Mag 7 we're talking
That's
about.
Right. It's essentially the Mag
Cool.
7, but it wasn't all of them. I mean, I think AutoZone might have been one of them. George can fill us in on that.
Yeah, I mean that test was just stocks with profitability above 80 or 90 and then below 20 or 10. And I would say the one thing that wasn't mentioned in addition to that, and I want to clarify, these are our metrics and also not something I run a tremendous amount. I didn't run them historically. So we don't know where that specifically sits historically. What is particularly interesting, though, is that the average growth score of above 90 profitability was actually more than above 80. And below 10 was actually less than below 20, which actually means to a certain extent, it's defying the traditional relationship of more profitability, meaning less growth. Those were the big numbers, but there wasn't a tremendous amount of distance between growth in the most profitable and least profitable companies, which kind of is a different way of what we're seeing play out here, right? Where it's just like where we're not necessarily seeing the smaller companies grow at higher rates. So that's just something to keep an eye on. And we obviously, if you're looking for a reason why there hasn't been as much, breadth to the market, there it is.
Yeah. So I guess I'll run through some of the topics I'm gonna bring out throughout the stream. Unless Matt, you want to just continue this talk with George since we already kind of got into it.
And do that.
Yeah.
And
I think we might as well. I'm here. We can just run through everybody can hear the topics as I do.
Yeah.
So, George, what I did is just kind of talk a little bit about what growth score means, what profitability means, and that you had talked about how small caps traditionally have the highest growth scores, larger caps, most profitable, often have lower growth scores because they don't have the ability to grow. But we're seeing a divergence there that some of the most profitable companies, stuff like NVIDIA, stuff like that, are having average growth scores that are very similar, almost the same as small caps. And so let me just read it. I'll read it slow so people can kind of pay attention to it. But some of the data that you found are profitability companies that had a profitability score of greater than 90, had an average growth score of 47.61. And so profitability score greater than 90, average growth score, let's say 48. Okay. Profitability score, companies that had profitability score of less than 10 means small caps, average growth score of 54. And so you've got these incredibly profitable companies that have growth rates that are almost identical as small caps. George, when I say historically, we didn't do like a big study on when it's happened before, but I just did some quick research on some times in the past where that had happened. And what I found is that the two times that the research that I could find was during industrial revolutions. It was times in the past where there was some new technology that wasn't just like a cool new technology, but it was paradigm shifting technology. It was life changing technology. And the companies that had the most money, had the most cash on hand, were the ones that were able to capitalize on that new technology and grow. Think steam engines, think electricity, things like that. And so, man, what's going on? Like, what's happening in the world, and what can we learn from this?
Well, I think call it what it is, right? We're talking about monopolies, right? Because I don't think it's necessarily technology, right? Let's look at I actually like the Gilded Age is a period of history I've actually studied a lot. And for those that don't know it, it's kind of like the age of the robber barons, the late 1800s, where a lot of these people really concentrated wealth, and there's parallels to now. But for those of you that don't know, Teddy Roosevelt was a big hero in this. He was known as like the trust buster. And one of my favorite things attributed to him is what he would say is speak softly and carry a big stick. And I feel like we kind of see a lot of the times the opposite in politics right now. Nobody
Word.
carrying around a big stick and a lot of bluster.
Speaking of,
Uh, but yeah, I mean, we're talking about monopolies, right? And a lot of these companies were broken up, and it's a good point. Whether it be like electricity is an example of a lot of the times we saw monopolies in that. If you're talking about Standard Oil, we're really just talking about access to an incredibly valuable resource. And a lot of the times we're talking about like railroads, not necessarily the steam engine. The railroads tended to be the monopoly, and the railroads tended to be the monopoly because only certain people could have access to certain routes. So they ended up being able to charge whatever they wanted after they scaled and after they built them. And they had some of these railroad buildings had some like questionable labor practices, like there's some parallels to today, right? And if you kind of look at all of it, it's just like the pattern that is repeating is that companies get a lot of market share. They grow. That growth gives them a bigger and bigger advantage. In the case of like Amazon, for example, Amazon's kind of got a much more traditional monopoly than, say, NVIDIA, right? NVIDIA only has its monopoly as long as it can make the best chips, right?
right.
So theoretically, that's an easier one to challenge, although no one's really been able to challenge it. But at least that's something that theoretically, could be challenged, but very hard when NVIDIA can spend the most money, dwarf anyone in terms of how much they can spend. But if you look at Amazon, right? Amazon actually is just doing what Walmart did, only better. And we've talked about on this channel before that Amazon really shouldn't exist as it does, because Walmart should have eaten their lunch and gone online and figured out the online supply chain. There's no reason for Amazon to exist. But Amazon basically stole Walmart's business. And Walmart's business is basically owning the supply chain, owning cheaper inputs so it can ultimately sell cheaper outputs. And we're about to talk about this later. Amazon is a lower margin business, right? Versus Nvidia, that, even hardware tends to be, lower margin, but because what they're selling is unique and limited in supply, right? It's always supply and demand. Nvidia can be, a much more profitable business than traditional hardware companies, because they do have that kind of esoteric advantage where what they build is actually just faster than what other people build. So it actually isn't like more expensive in what they're able to charge. And the other thing they do really well is sell into businesses where their hardware is increasingly becoming the solution as well. And that's why they're increasingly talked about as an AI product company, right? But it's all the same thing, right? It's all the same thing as we talk about Google's monopoly. It's just someone, but that's, one that's kind of under attack, interestingly enough, after being kind of the most solid one of the last 20 years. So, these things can go through cycles. Monopolies can be challenged, but traditionally, what we rely on is the government to break up monopolistic behavior, right?
And you said something interesting about the government currently and their view towards monopolies. Talk about that.
Well, yeah, actually, when I was at the Fast Company Innovation Festival a few weeks ago, I missed her speak, but everyone said that the FTC chair was very interesting, and she's a young woman, like one younger than me, which is crazy for an FTC chair. But she's supposedly going after the monopolies. I mean, it's one of those things where I was like, well, everybody says nice things about her, and I'm not disparaging her, but it doesn't seem like it's really working. I haven't seen any right. monopolies, but I also admit it's a hard battle. But yeah, it's kind of like, the most recent one that we really have is, the AT&T, monopoly breaking into like the Baby Bells, like, because they used to own all of, the infrastructure for phones. And then Verizon was actually branched off of that. So which is now arguably the bigger company, but they, I would argue, are that because they're better run. But yeah, traditionally, in terms of monopolies, you'd probably look at Google being a monopoly. You probably look at Amazon being a monopoly, and people say Amazon is especially a monopoly now because of data, right? When you have your data on AWS, right, and then that gives them so much more knowledge of how to sell and what's going through the pipeline and everything. So, that becomes challenging for you to go in and compete with them on supply chain, because they just know it better, and they know, what prices they can enforce, and their orders are so much bigger that it's hard not to do business with them. So they've turned into, especially with the AWS thing, much more of a traditional monopoly that, would be looked at to break up. In terms of looking at the rest of the Magnificent Seven, those I would say are the two most egregious examples right now. But we do, as companies get bigger and bigger, it's going to be, harder and harder for other companies to compete. And that's not really, that's, you kind of look at Microsoft, right? Which, if Apple didn't do so well, would probably maybe even have like a pure computing monopoly. And they kind of beat them on design, but Microsoft had their way of weaseling themselves into everything. And that's why we when we talk about it, like, it's possible they're going back there. Look, they're now ChatGPTs on Microsoft phones, right? We might see Microsoft be like a huge computing monopoly again. If they can kind of get GPT and Copilot, like, you hear such good things about that, they'll be doing something similar where they're just embedded in every phase.
But that's a great example.
What
taught me, George, is that you're like, the reason that these monopolies happen is because these companies that have so much money just laying around, that they can go get the best talent, they can buy the best products, and that's what seems like Microsoft is doing. I mean, they're just spending money so they can get the Chat GPTs onto their stuff. Is that what? Would you agree with that?
Well, yeah, I actually love what Steven titled this short. I saw it was called like the AI food chain, and it was very smart because we were talking about how ChatGPT kind of had, or OpenAI kind of had to sell ChatGPT or a part of it to Microsoft because the compute got too expensive for them. And then you have Microsoft and BlackRock competing to, I mean, sorry, building these, computing centers, because the job might be getting even too big for Microsoft, where they need a partner, right? So I think that that's the big, that's kind of them telling you they're building out infrastructure to be a monopoly, right? If they need so much compute that they don't even anticipate like being able to pay for it themselves, and they need like a financing partner, that's them, kind of writing in the sky that they expect to be a monopoly. Same kind of thing with Sam Altman and the nuclear power. He's maybe saying that, hey, I might not even want to depend on Microsoft. I might want to just be able to long term power all this stuff myself. Um, so yeah, I think all of that, like, we are kind of seeing the path of business towards these companies just getting big, more and more and more concentrated. And it's kind of like with the government not stepping in and we see them getting bigger and bigger, there's kind of no path to avoid, ultimately them kind of just being these like conglomerate blobs, right? Where they own more and more and more stuff.
What does that mean for small caps? It seems like to me that for a small cap to become, a profitable, established company, you better have some product that nobody else can do, or you have some technology like ASTS or whatever, or that you have a product that other people are going to buy. It seems like it's going to be harder for small caps. Am I misreading that going forward?
Well, I forget what I think it was like. I think it was about Microsoft. I don't want to be like where it was something. I forget. It's pretty famous where actually it's a story that I heard about someone who was going to sell, who ended up selling their company to Yahoo in the tech boom. And basically they were just like they walked into Yahoo and they were just basically like, well, sitting on our shoes, we have a few options. We can buy you or we can crush you, right? And I think that that's like, it was like a calendar. It was like a calendar app way back in the day when there weren't calendars, right? And I think that is, basically what they're referring to is, what a big company can do in terms of just like ripping off what you do, looking at the design, building it, and then basically charging less than you can afford, right? Than your investors can afford. Because a large company always has that ability to beat you out. And that's what Amazon did, right? They just beat everybody out on prices, and then you end up raising them later. Uber, Lyft, all the same. The list is as long as you can think about in terms of this like monopolist behavior, right? But the problem is, and I think it is going forward, what you actually see at these large companies, because if you've never read Lean Startup, it's a great book. It'll really help you understand how to do, I think, better at your job in terms of cultivating ideas, but also, kind of how innovation dies at these larger places.
Yep.
And, what I've heard about for like at Google for a long time is a lot of who they promote are acquisitions, right? Because they don't know how to cultivate talent from the bottom up anymore. So they actually acquire companies to either get their technology or have access to their executives. And I say that because at a certain point, these companies just get so big. And I think ASTS is an interesting example where it's just like, I think you have to have founders that just have a big appetite for risk to not sell to, say, Verizon, right? You got to be good at gathering that capital. And then you have the risk of people, competing with you or whatever. I think increasingly what will happen with small caps and why there's not any great small caps is they tend to sell, right?
Yep.
Especially with the venture environment the way that it is. If you have a promising company that could ultimately go public, I think more and more, venture investors want that exit, right? And they want to get you selling before you go public. So I think that's why there's less and less of these companies, like they'll still exist. But I think part of that is like, is circular, right? You can say there isn't as much deal flow, right? And that would be true, right? In terms of like high growth companies that are public that you can buy. But I also think that that's a bit of a self-fulfilling prophecy now, because a lot of how companies are funded and they see their peer groups or everything is kind of with the assumption that once you start to build a good business, like you'll probably want to sell it before it, has the potential to go public. And I think we see both of those things happening. I think we see large companies that are just better at growth right? That because they're just, creating faster, it's basically hard as a startup or a smaller company to get the same, scale
Right.
advantages that they have. And that could be inputs, that could be R&D budgets, it could be marketing budgets, it could be so many different scale advantages, right? And I think the other portion of it is that companies are like in this ecosystem selling to those faster because they don't want to have to compete with those companies. They just want to prove themselves enough to a point where they could be interesting to acquire.
Well, it's a fascinating conversation, so much so that we actually got an email from a reporter from U.S. News asking follow-up questions about it. This reporter was like, man, this is super cool. Tell us more about it, George. And so it's going to be interesting to see what happens in the years to come and how this plays out. We live in fascinating times. And so, Stephen, man, it's good to be with you guys this morning. I'll pass it over to you. Hope y'all have an amazing time. We'll see you next week.
Thank you, Matt.
See you,
I
bud.
thought that was definitely a very interesting topic, and yeah, how it shakes out is going to be crazy. Without these companies getting broken up, it's tough to see a future that's different than where we are today. Um, but spinning into some of the events that we have in the market this week, I want to talk about a little bit of the macro situation we have playing out. So last Friday, there was a jobs report that came in very strong. Uh, and it was taken by the market as good news was good news, which was interesting. But now we have oil prices rising, which we highlighted last week with the tensions going on in the world. Um, so, George, I know the Fed has a dual mandate: inflation and the jobs market. Is their rate cutting path going forward becoming less certain with the strong economy that we supposedly have with these job numbers? How do you think it's looking after some of the data we've gotten recently?
Well, I think Powell like backing off a bit was interesting. And the strong job numbers are also very interesting. In terms of, that looked like it was going to slow down, but it's hard to say, right? I think if jobs don't look a little more choppy and there might be a little disappointing, like, there's as Powell says, the numbers have got to come in, but or will be data driven, right? So I think if inflation keeps coming down, I have a hard time, regardless of the jobs, not seeing us continue to cut. Like, I think it would be very weird. I think we've got to at least see another 0.25. But maybe there's a pause after that potentially because it's a little weird to do 0.25 and then stop. I think basically if you do a non a zero and then a 0.5 and then another zero, you're kind of admitting that you were a little, you might have been a little late. And then you're kind of admitting that you might have been a little too aggressive again on that 0.5. Not necessarily. I mean, at the end of the day, you might want to be more aggressive and then back off. But I do think they'll have another 0.25 for sure. But there could be a pause after that. I just think it's like there's too much going on, and I'm just kind of seeing um okay, yeah. The market I was just talking myself, and the market um does agree that to an 83.5% chance that we're going to get another cut. So it does seem like everyone's pretty certain on that. But I think that it's smart for Powell to hedge a little bit in case he does want to, rein it back, especially after who knows what's going on in the election, who knows what's going on in the markets. Although I would say that there's kind of more concern for the markets as I see them. But yeah, I think without even checking the numbers, that was my instinct that we're going to get another 0.25 cut. But after that, if jobs remain strong, I think we might have it pull back. But I'd say only if inflation doesn't keep hitting or beating expectations. I think we could have strong job numbers and inflation continuing to subside, in which case, rates are relatively high and it makes sense to keep cutting them unless you see a concerning inflation number. That's kind of how I see it.
So one thing I want to mention that I was seeing floating around is that we had big job revisions downward in prior reports already this year. People are wondering how much can you trust the report we actually got. But you're also mentioning inflation, which we have a CPI report Thursday. And one of the things that maybe is concerning for this inflation report and maybe future ones going forward is the movement we're seeing in energy, which kind of can, I think, be a trigger for the entire inflationary environment of products and supply chain and all this type of things. If oil and gas prices go up, could we see inflation be a bit stickier? And is that a concerning trend for you that we're seeing?
Potentially, yeah. I mean, but I think that's like, I think they're smart enough to know if like other things, if other pricing is not going up, that it's energy driven, right? Like, because energy prices can be, geopolitical and or cyclical. So if the main inflationary points are that energy prices are going up, I'm not sure that is, what people should be looking for. You know, I think that they might kind of be able to make that determination and feel a little safer on that basis.
And when you were talking with Matt before, you kind of were mentioning about the low margin businesses topic that I wanted to bring up based off this kind of energy rising, maybe cutting into the profits of some of these companies and businesses that have low margins. I saw this story about Hershey's was kind of already warning about profit margin being weighed down by input cost pressures, which would be energy. Um, should investors kind of steer away from low margin businesses at this current time, or maybe in general in your eyes with the tech that we have to be able to track our AI technology to be able to track tech stocks very well, which tend to be higher margin. And then maybe some of our viewers aren't really sure if they're investing in low margin or not. Maybe they don't pay attention that deeply to the stock. So maybe if you want to mention some areas that are lower margin in the market.
Yeah, so I think there's a few important points there. I think the first is, what are low margin businesses, right? And I think generally, I mean, retail is a good example, but if there's a lot of competition and low prices, right? Think fast food, right? Those tend to be low margin businesses. If there are expensive inputs to the business, hardware, for example, is generally, and if you think about Apple's the really good example, right? They're manufacturing everything, their phones in China at Foxconn because that's the only way that they can, the parts alone are expensive, right? Which is, and that's a lot more. Again, you're kind of talking about competition, right? We were talking about Nvidia earlier. The parts are expensive to those chips, but they're adding a lot of value. We talk about that they have software that optimizes them. That's one of the things that Nvidia does very well to make them into products, right? So right there, we're even talking about the difference between a lower margin hardware piece and a higher margin hardware piece where there's demand and less competition, right? Apple has a tougher environment in terms of comparable hardware increasingly exists, partly because I think they're getting ripped off, but partly because they're not innovating, right? But I think anything, furniture is another good example of low margin because it has shipping costs to deliver, and again, the inputs, the manufacturing, things like that are going to be hard. So the other part about that is it's always good to understand things from a value perspective, right? Just because low margin businesses, are less good investment ideas, it doesn't mean they're expensive to buy, right? That's why you always have to look at things like PE ratio, right? Because at a certain point, if their earnings are stable or even going up a little bit and they do have a good relative PE, it's possible you could get a low margin business at a discount, right? So I think those are all always good things to look at. But yes, I think that that's one of the things that we like kind of keep talking about on the stream that I do think are important. I think people increasingly and retail is increasingly willing to pay for high growth businesses, right? And high growth businesses tend to be great margin businesses. Like not always, Kava is high growth and it kind of is, not as good margins, although it is at a higher price point than other fast food. So, it is not all the way down at, say, like a McDonald's in terms of like in terms of a margin. But uh it tends to be, if you think of like something like Tesla, that's like a very popular high growth. It gets a lot of like energy behind it. That's not because it's making a lot of money today. Um, it's because things in the future like full self-driving would be very high margin, right? Because they've already sold it and that's pure profit. They built the technology that's almost pure profit on something like full self-driving. Or if you think about like selling robots, that's a hardware business, but if they're like the first game in town to that, they can sell that at a huge markup to what it costs them. So I think the market is willing to pay for growth right now. But it doesn't, you can always look for value, and I think that Prospero is a good place to look. Like I think Dick's Sporting Goods is pretty high right now. I didn't check how it's doing today. But without looking at a deeper value analysis on that, I bet it's cheap relative to its peers, and people are betting on some better quarters there, and or just that it's underpriced and the market will start pricing it more correctly.
And speaking of how, the market is willing to pay for growth, I'm happy that Jonathan brought up Meta for us to talk about, because I saw it cross 600 this morning, I think a new all-time high. It's amazing to see the stock keep going higher. He's asking, are you surprised that Meta has done so well this year and it still has a 100 upside? Or does this fall into the narrative that their profit and growth rate are high as an investor and would rather invest in Meta rather than a small cap stock, kind of like how we were talking about in the beginning of the stream?
Yeah, I think the latter is true. But sometimes if you're on like I'm increasingly on like these Twitter spaces or X, and one of the things that constantly gets brought up, and I actually like the way it said, is it's like people didn't like Meta at 200, but they liked it at 500, right? Where it's just like sometimes the biggest thing a company needs is just to show that people believe in it, right? Because ultimately, the way Meta was treated before, you kind of had to price in that people didn't like betting on Zuckerberg, right? And that's a real thing. You have your company numbers, and then you have the way the market treats a stock, and you have to respect the way the market treats a stock. Like, we no longer live in the value days where people could necessarily say, no, this stock is, definitely going to go up, or this stock is, I think it's more true the inverse. I don't think you can say this stock is definitely going to go down with Nvidia, Tesla, or whatever, just because it's like overpriced. Because who's to say when retail or anyone's going to decide that it is actually overpriced, right? So you could lose a lot of money waiting for that correction, in quotes. But the important thing for us, right, is we do see ongoing innovations in open source, and we talk about that. We see new products like their AI product. A lot of people say is going to be really good, and they might even come up with like a Maps thing, which could they've always kind of hated Google. Then you also have a stable growing business, and a lot of ad revenue coming in from the election. So there's kind of even just like a short term boost there. So yeah, I mean, I definitely think that a place like Meta is checking all the boxes, and keep in mind for upside breakout, right? There's got to be live option bets, right? So that is what it is, unless people are becoming more bearish. If they continue to own options above where the stock is trading in the long-term options markets, upside is going to stay good. If price targets continue to get raised, they're getting raised, right? That's how it stays at 100. And then price momentum also has to stay where it is. But that's an important part of upside breakout and why we are so confident on the longer term, because it's got different legs to it. Unlike net option sentiment, that is like pure options pricing, upside has different legs to it. And if the analysts keep raising their price targets and the option bets stay live and good, why wouldn't we keep being bullish on it if like those two important checks continue to be bullish?
Yeah, it would seem that there would need to be like an event or a news story or something to change up the momentum that the stock is having or experiencing at that point. One of the
Yeah.
stocks,
Can I add one more thing?
yes.
Right? Technical analysis might say overbought, right? And you can miss opportunities if you're just looking at that, right? When you look at it the other way, where you're just like, well, they keep making smart decisions, right? Profitability stays strong. They're entering new markets, building new products, right? Analysts like them. When you kind of look at it like that, what is the story for the stock going down, right? Just because it's gone up, when we've actually talked about, like, one of the most important things in a stock going up, in the next year, is the fact that it's gone up in the last year. Sorry, that is the most important single variable if you're doing like a one variable analysis, right? So it then becomes like, it's kind of, if you inverse it, it's kind of like, well, what's the story for it not doing that,
Yeah, and I feel like all the things we're saying kind of go hand in hand with the next stock I'm going to bring up, because the time is nearing where Tesla is going to be having this robo taxi event this Thursday, and we've been talking about this for a while now since it got pushed back. And I'm getting a little nervous since everybody's talking about it and everybody's expecting such good things. Are we setting ourselves up for the sell the news event? That's what I fear. When I was talking about this with Matt before the stream, he mentioned how he was looking at Tesla and Prospero, and it, like you were saying with the signals, I think it was still a 97 either upside or net option sentiment. So it still looked very good. There is speculation going on that in this event, they're going to share data for full self driving that proves that it's already safer than humans on roads. Um, so, how do you think the market will react from this? And then, if they share that data, what does that mean for the product?
Well, one of the things that I want to draw some attention to uh, is that the downside on Tesla was 31 on October 1st, and it's 42 now, right? And 42 is not a 42 is not necessarily like a low downside number. It does have 90 upside, but that's why the two numbers are pretty independent of each other. Or they are independent of each other, because we wanted to have those like two different flavors. So yeah, I think when you look at it like that, it is a little hard, right? It's a little hard to say like, oh, everybody's bullish, because not like increasingly people are nervous in the market in terms of how they're betting. So I think you have to be able to look at all of that. Uh, and in looking at that, um, understand that there's a lot of binary events involved in Tesla, like this, and like maybe people, wanting it to go a certain way in terms of how the announcement goes. There might be a sell on the news thing. There's the election. There's like a lot of this. I even saw an article about, how it is odd that, and I've been saying this before, that it is odd that as like the election has gotten closer, um, Musk hasn't like hedged himself at all, right? He's kind of all in on a single candidate. And you never really see that from like someone, the head of such a large public company. Um, so yeah, there's a lot of reasons why I could see those, bets on both sides on Tesla. And it's probably why we won't play that event. Maybe we'll play it in our trading portfolio. But I don't think it's a slam dunk. I think there's a lot of risk, but there's a lot of upside too. But in terms of our high conviction portfolio, I think that there's just too much risk of, I think, especially in the short term, the sell on the news event, because I think you have to look at Tesla as something that's momentum traded, right? And something that's momentum traded just inherently has a much bigger risk around a news event. That's something that trades closer to its like true value, right? And you have to look at a company like Tesla as something that, trades above its true value. But there's a reason for that. It's because a lot of people, retail investors, are excited about that, and a lot of institutional investors, as a result, are playing momentum around that excitement. But it does just make some of these events just a little, hard to read, um, and too risky to play, at least in my high conviction portfolio for me.
And just highlighting this theory that's going around that they're going to show data that shows that the full self-driving is safer than humans already. If that actually comes true and they're able to, release something that's convincing and actually proves it, would that do anything in your mind? Because I know the big worry is like, is it going to be are the regulators going to allow it? But if they're proving with data that it's safer, I feel like it's going to be tougher for them not to. So, is that a big thing for you to watch during it?
Yeah, I mean, the thing about that, and we obviously talk about that portion of this a lot here. I think the interesting thing about that is just basically that um, that's not the hurdle, right? I think everybody knows that like these cars are going to be safer than people, if not today, at some point, right? The hurdle is nobody knows how to deal with the fact that once these things are released, they will have accidents, right? They're not going to be held to the same standard as people. People are way more uncomfortable with the idea that they might get into a crash with a robot, or like a robot is going to kill someone, right? And that's the part that it's like, I think people think, I think the biggest thing that I've noticed, like being highly data driven myself, is the people that think they're data driven way outnumber the people that actually are willing to go with the data. Because I'm willing to go with the data. I'm willing to say that there's going to be problems and there's going to be accidents on the way here. But there's a lot of people that will even say, like, oh, the numbers are there, but will very much not respond by saying, like, oh, the numbers mean there will be deaths, right? The numbers mean they're not perfect yet. They might be better, but they're not perfect, right? And there's going to be deaths at the hands of robots. And I think there's a lot of people that don't understand that part about the numbers. They'll say that it's fine, that it's better, until they actually see that those numbers still mean that there's going to be accidents by robots. And I think especially like elected officials, right, that might think it's cool the second, an accident happens in their district or one of their constituents. I think they're going to be singing a very different tune, even if they say they're all right with the numbers to begin with.
Hmm. Well, some numbers we just got back were not too good, and there was a death. Speaking of deaths, at the box office this weekend, the Joker movie that came out, highly anticipated. They tripled their budget for this movie. It only made half, $40 million of domestic box office than the original first movie. I'm wondering, could this lack of interest and lack of spending in this movie be a sign that the consumer and the overall, economy is that a weak sign for the economy and the consumer, or is it more of a micro, more nuanced, like nobody wants to go to the movies anymore? It's just kind of playing off that. So which area of the spectrum do you think it's in?
Um, I think what what it kind of feels like to me is that the movies that people are just really, really excited about, which I think are less and less, especially with kind of streaming taking a lot of the talent and that going to kind of, shows there. There's just less talent, I think, making movies now, which means that there's less big movies that everybody's like excited about, right? I think those still carry, right? We've seen it time and time again that if there's enough buzz around a movie, people will go to the theaters just to be able to see it early. Although I would argue that they could be smarter about those pricing models. I don't know why um I could easily pay 20, 30, $40 for a movie rental, right? To see a movie I'm excited about, and actually would strongly prefer that. And I do think there's a spot for that, like going forward. Once the theaters like kind of do what we talk about with like streaming, where they just kind of accept that it might not be the same, but they're losing out. But I also think just like there's fatigue with the lack of originality in the movies, right? Like I thought the Joker movie was cool, but what is this? Like I feel like this is like the fourth or fifth reboot of Batman or Batman related things in like the last 10 years, right? And there's some fatigue there, and it's just like, okay, maybe this Joker's got a new angle, but then they just like, I feel like Hollywood is always pushing it too far. They're like, oh, that was a good movie. Let's spend 3 times as much and make it another one. And it's just like, no, I think what was good about it was that it seemed like an original take, but then you're taking that original take and you're just like squeezing all the originality out of it as you like push it, more and more. And I think that, that is kind of the big problem. And it's just like the quantity. And I mean, I can't think of, I used to go to the movies a lot with my parents, and I love movies. I watch a lot of movies, but my desire to go and my excitement, like I can't even remember how many movies I've actually been excited about going to in the last 5 years. And I think part of that's like the pandemic just kind of killed, kind of the instinct to go there. But even then, like I just can't think of that many that I was actually excited about. And I think that's probably just the talent thing that we're talking about, has been going to these independent production houses to build for streaming. But I think that's, like these things, I think that's their major problem. I think if they had good movie after good movie coming out, people would still go to the theaters. I just don't think there's that many good movies coming out, or a lot of them are just like reboots, right? How many, what percentage of movies are like reboots of something? Or like, I'm just thinking about like, look, I'm all for women's empowerment, right? But like an example of like the Ghostbusters movie, right? Where it's just like, there's like, it's Ghostbusters with women. And that's like the whole concept, right? It's just like, it doesn't feel like they had any new ideas about it, right? And that was the problem. Like it could have been cool. I think it had a great cast, and it could have been cool if they had a concept other than like, hey, let's make Ghostbusters be women. But I feel like that's the extent of the creativity behind some of these things. And then you just like, and then that's the thing where it's just like, had that been a good movie that everybody was talking about, I loved the original Ghostbusters. That would have been something that I would have wanted to see in theaters, I think, but I didn't hear anything good about it. And then I watched it when it came to, streaming, and that was the extent of it, right? There wasn't like, there should be, oh, I like have a great idea for a Ghostbusters movie, right? And like, oh, wouldn't it be cool if we put women in it instead? And I don't think that's where these concepts start. I think it starts with, we should make women Ghostbusters, and then they're just like, well, now let's invent what it's about, right? And they don't necessarily start with the good idea for the movie that they then put like a better, a more, a different spin on the cast, right? That empowers, different groups, which I'm all for. But I think it should start with the idea being better.
I completely agree. It's like the movies are made with an agenda, and even if that agenda is positive, like you would agree with it, it can't start with that. It has to just kind of feel more natural. People are a little bit tired of that happening, but I think Hollywood is starting to react. And also, one thing I want to ask about with the story, because I don't think we've ever talked about it before, and it's something I've seen where people are saying that the AI video generation and the next phase of content going forward, like, so some AI company will, I guess, start up and be able to track your data, and then instantly, by what you've watched on like all these streaming platforms, be able to create a full-blown movie for your style, your taste, personalized, one of a kind for you. I'm wondering if that will ever gain popularity, because I feel like part of the reason people like entertainment is to talk about it with their friends. So if it's a movie only for you, I don't know if that'll really catch on, but how do you feel about that?
I think I think people talk about personalization a lot, especially in AI. But I don't think people, like, anytime I hear it talked about, I don't really see like that nut cracked very well. And I'll talk about it within investments, right? Like, because that's where I have most knowledge of it and how it's talked about. It's like, okay, your investments are personalized, but is that something that people really want? I feel like what I want is for my investments to be the best investments that, in a risk adjusted way, right? I don't need it to be products I use or causes or whatever, mostly because like I don't think you should mix charity and investment, right? If you have a cause, I'd rather have more money, right? And then invest that money in a cause. not mix those things and maybe not have good returns because I'm trying to mix investing and a cause, right? So there's a perfect example of like, do people really want personalization? I think they only want personalization in theory, right? I think they want to they want to invest in causes they believe in, and they want to make just as much money or close to the same amount of money, right? But there's no evidence that they can do that, right? There's just, especially when it comes to if you're really like, looking at things like ESG, right? Where it starts to be like, well, if you look at some of the things in ESG, like these carbon credits of like companies getting like offsetting their carbon by like having people not chop down trees that they weren't going to chop down anyway. There was a big like John Oliver on that, right? So are you actually getting your cause, or are you actually supporting kind of the antithesis of your cause, which is people virtue signaling and not doing shit about the thing, right? And just like taking your money, and if anything, I would view that as counterproductive, like empowering people that are faking, actually caring about a cause. So I think it's tough, and I'm not saying all ESG is bad, but I'm just saying that it's a really complicated problem that I think people think they're solving better than they are, and I just don't think personalization is there yet. And I think sometimes, like I'm saying, it's used in areas that it shouldn't be used. Like I think people should be minimizing their risk and maximizing their return as much as possible to create wealth for them and their families, that then if they have excess wealth, they should absolutely support the causes that they want. But businesses aren't causes, right? Businesses, I think, pretend to be causes, and that makes people feel more comfortable, but they're not causes. They're there and should be there to make as much money as they can, and they should absolutely care about doing good. But I don't think we even have good systems to measure if companies are doing good. So I think that's the thing that kind of makes it more of a waste. And I also think versus investing in different things, I think the best thing that someone can do is not giving their dollars to businesses that are doing poorly and giving their dollars to businesses that do well. In terms of investing, I just think that there's better things that people can be focused on, and avoiding companies that you think are bad is perfectly fine. But the idea that some like AI optimized personalization thing can do a good job of that right now, I think is crazy.
Well, when you talk about it related to investing, it's kind of the Warren Buffett mentality that you've shared on the stream a couple times. Of like how he believed in himself to make more money than, and he would donate that after he was able to compound it for so long. So it's interesting for people that haven't seen that before. That's kind of what
Yeah,
that mindset is hitting on. Yeah.
or start your own charity, right? Right now, a lot of the times, like, 40, 50% or more of the charity is going to like fundraisers and salaries and everything like that. Whereas if you actually like, you know, have that kind of means, you can kind of put it in a different, you can put it in your own structure at the end. But yeah, there was a funny like I was like talking to someone about this, and they were just like, oh, I wouldn't invest in Meta, when I said that Meta was one of like Prospero's favorite companies, and they're like, why? And they like brought up like the election and things like that, and I'm just like, yeah, fair. Like I don't think speech should be monitoring. I don't think these social media platforms should be affecting like elections one way or the other. That being said, I don't know anyone that's handling it well, right? And Meta like is facing the same difficult problems that any social media platform is. But I don't think any of the social media platforms are handling it well. And then once you get to that point, it's just like, well, where do you place Meta on the spectrum of like companies that do bad, right? Like pretty much any company that doesn't have good worker rights or is like building things where labor's bad, that's, I'd say they're doing way worse things than Meta. Then if you start talking about like the healthcare industry, a lot of the ways that they are getting profits, I don't. I think some of those decisions cost lives, right? And I think that you could look at a lot of like supply chain like chemical companies, things like that, what they're doing to the environment. The list goes on, right? You could probably pick out bad things about a lot of companies. So when you think you're doing the right thing by not investing in Meta, which is a company that we've ridden up a lot. Are you really like are you really holding back from something that is actually worse than other companies, or are you just holding back from you making money yourself?
No, yeah, it's a great point, and I want to kind of continue on this topic that we're on, talking about the American dream. But before I lead us into our final segment, I see that we've had close to 1,400 people on the stream, so thank you all for tuning in. If you enjoyed the content so far, be sure to give our videos a like on wherever you're watching. We also post them on Spotify after, so if you're on YouTube, you click the link right in the bottom, and you can follow us on there. But I want to talk about the American dream before we switch over to the model portfolio update right after this, because I was seeing this thing flying around social media over the weekend, which was kind of crazy. The American dream today costs $4.4 million. And coming up to that number, it was the cost that someone will experience over the course of their lifetime in America. And what went into it was retirement, owning a car, a wedding, raising two kids plus college tuition, owning a home, pets, vacations, and last but not least, your funeral. So, $4.4 million does the American dream still exist today, George? Is that an attainable goal for most people? How can Prospero help people reach the American dream? Take it away.
Yeah, I mean, I think that those are all great questions, right? And I don't think the American dream really exists anymore in the form that it did, right? I think the American dream, what it was, really was actually embedded in buying a house, right? And the fact of the matter is, if you look at relative like salaries to home prices now, it's just like night and day. And those have been driven up by like a lot of people, owning a lot of houses, foreign investment coming in, and like a lot of that stuff. These big private equity shops owning houses now, which is, yeah, kind of the antithesis of the American dream, right? And I think that's where it fails the most, right? It used to be, I think a lot of our parents were able to buy a house or multiple houses based on, not even necessarily like the most high paying jobs, especially where you live. You could have like, you know, I think in the old, like even in like the 20, 30, 40 years ago, you could like work in a factory, right, and buy a house like in that area. Like that doesn't really exist anymore. Like you could probably rent a house, but you can't buy it, and if you can't buy it, you can't get that, like, I think a lot of earlier generations accumulated wealth through their home and the appreciation of their home. So I think that that's the biggest kind of death of the American dream right there. And I think the healthcare system, we have one of the most expensive healthcare systems in the world. That's not helping anyone, and you see a lot of people kind of get sick and lose their life's fortune from that, and that seems like the antithesis of the American dream. And I don't think any of the political parties are looking out for the everyday person anymore. And it just shows in the numbers. And that's sad. And yeah, that is one of the things that Prospero is trying to help, right? By bringing, I think it's kind of reversing a problem where increasingly retail investors are just led around with bad information and are kind of at the whims of these institutions that kind of send them what they need to see to move them in different directions. And Prospero is built to just like cut through a lot of that noise and let people see like not what institutions are saying, but where they're really putting their money, so people can get on the better side of investments, on the better side of trades. And yeah, Mario, I think that's a great point. My dad grew up in a one-bedroom apartment with him and his three other siblings in Washington Heights, and they all went on to do great things and be homeowners and everything there, and they grew up very poor, right? And it's a lot harder to do that. It's not impossible, but it is a lot harder to do that these days, and it's sad to watch.
And my family, George, probably started near yours. I believe Hoboken is near Washington Heights, probably, and moved up to Bergen County, New Jersey. And I can, attest to everything we've been saying. I'm kind of in the middle of like my cousins of my family. So I have a couple that are older than me, and it's crazy. All of them have moved like an hour away into West New Jersey because you just can't get anything in our area that's like affordable for someone who's 30 and low 30s, late 20s. It's crazy, and I hope to see it change in the future. I think people like us, and I see it brought up a lot more nowadays, the problem. So hopefully, with people talking about it, stuff will change.
I mean, what can they really do, right? It's like what are they going to do? Artificially lower real estate prices? Like,
Wait,
are people going to do anything to like raise salaries? I don't.
25K for
It's
first-time home buyers. I saw that. Yeah,
yeah. I mean, it's a big structural problem.
yeah. Um, but that will conclude our topics for the day. I thought it was a great stream so far, but George, we'll see you over in the Prospero laboratory for the model portfolio update.
Yep.
So stick with me, chat viewers. I'll take you through the Prospero.Ai net option sentiment current readings for the QQQ and the SPY. Thank you all for tuning in today. Let's take a look at the markets overall. I didn't really get to update everybody when the stream started. Okay, so let's look at QQQ, SPY, Dow, and Russell. All are negative on the day. SPY and QQQ are about the same, 1/3% lower. IWM down 0.79%, Dow Jones down 0.5%. So all are red on the day. Let's get a look at the net option sentiment readings in the QQQ and the SPY, which recently, when we've been looking at these readings, they've been high. Typically, SPY has been about 10 to 15 points lower. QQQ has been upper 50s, low 60s, and SPY, upper 40s, mid 40s. Okay, so looking at the QQQ, it is currently at 58, so still a high reading on the QQQ for our net option sentiment, which would lean bullish. And then SPY is at 42, so I believe we'll ask George when he gets back in here. I believe the 42 level for the SPY is still bullish, but I think it's teetering on becoming and it's definitely more difficult as it is to get a clear reading being at 42. I think if it dips down into the 30s, it might be a little more concerning for the direction of the SPY going forward. And the fact that the QQQ and the SPY are becoming so separated, it's an interesting phenomenon that we're seeing right now. So, George, we just looked at the QQQ and the SPY. QQQ was at 58, SPY was at 42. SPY at 42, does that feel bullish to you, or is it kind of in the middle where it's getting a little harder to read?
I didn't have the speaker on for a second. What'd you ask? Sorry.
Oh, no problem. Just we checked out the QQQ and the SPY net options. QQQ was 58, SPY was 42. What does a 42 reading in the SPY mean to you? Is that bullish, or is it kind of in the middle and a tougher to read situation?
I mean, we might change our levels soon. It's not a bad idea. I mean, that's bullish according to like how we read things, right? That's why we set our bull bear levels. But I have been considering moving it up. But I
It
have
is.
not yet.
It's interesting to me to see the SPY is still so much below the QQQ with the energy strength that we've seen recently. I would figure that would boost the SPY more than the QQQ, but I guess we're not seeing that.
Yeah. Okay, getting everything set up here.
Just like always, though, the Russell is the leading on the downside today.
Oh, it is?
No change there. Yeah, it's down 0.8%. QQQ is down like 1/4%. So doubling the losses.
Interesting. Taking a look at the lay of the land here. looking.
I think I heard you mention something that was interesting to me. Maybe I could ask you right now. Like, since the Prospero model portfolio has done so well this year, is that affecting the moves you're making because you've already had such strong performance? You're not really taking as much risk right now as you would in the beginning of a year, or if the performance was not where it is right now. Um, I thought I heard you mention that, but I'm not sure.
Yeah, I'm just like looking. There's some input errors here that I gotta fix. But yeah, I mean, because I saw it go down and there's a few input errors, so I've gotta fix some shit.
All right.
But I was like, oh, well, not doing as well as I last looked. But there's 3 errors that swung the wrong way on the side that I have to fix. But no, I mean, I like right now I've approached it like increasingly formulaically, right? So I'm just looking and I'm adding and dropping, based on what based on what I'm seeing. So I think if there's anything, I am keeping a smaller portfolio, but that's just because it's become easier for me to manage.
Mm-hmm.
Uh, okay, here we go. Okay, you said 42 and what?
42 and 58.
Oh, that's a pretty big divergence.
We continue to see the market be indecisive generally, but also on tech. Although other than industrials, defense, and utilities, it has offered the biggest returns lately. Which is why we continue to play it.
All right, it's open already. Okay.
We have become pretty overweight energy in this portfolio, and it seems for a good reason. As a result, we don't think we will overbet on it. Just stay the course on our energy-weighted portfolio.
Look at this. So overweight energy here.
Warren Buffett would be proud, George.
What's MRO? I've never even heard of MRO. Looks like it's time to get in.
Empowers healthcare organizations with proven enterprise-wide solutions.
Why is that energy? Oh, either way, we're... Oh, God, I'm being an idiot. I was like, there's no way that JPM is that high in the signals. Okay. This makes more sense. Okay. SLP.
Schlumberger.
What?
SLB is Schlumberger.
Oh, okay. Is that energy?
Yes. Provision of
Okay.
energy technology.
ENVX is back in on the menu. Okay. I'm going slowly today. Okay. Do we have any NEU in the portfolio right now? I think we do, but
Looking. Loading. NEU. I see one right now. Still loading though, but definitely one. Oh, no, wait, that one was closed. So we don't have any right now.
what's going on with materials today? Okay, I think I feel good about that. And I just need to check if there's any. I'll leave it. I'll see. Can you tell me what DKS is going in net option sentiment?
EKS is at 7. It was recently at 48, so new lows or approaching lows it was recently at.
Is it 7? Okay, we're definitely getting out of that. Okay. Okay. I'm making a lot of work for myself here. Oh, I'm going to send this now. There we go. Got it out at 12:20. Okay. Oh, I was going to check.
Right.
I was going to just check one more thing. I was going to check the current newsletter picks. Those look good, although I'll keep my eye on KBH. Those all look good. Okay.
Well, it's been interesting to see the rotation and energy we've been seeing, and we'll see. We'll be back Wednesday, 3 p.m. See if it continues till then. But thanks everybody for tuning in. No questions. Thank you, George. We'll be in touch very soon.
Thanks.
Bye.